Welcome back to Everything Money. We bring you more from our wonderful interview with Mohnish Pabrai, the investor we did in Austin, Texas in his office. This is the second video in our series of 4. In this video, we talk about the mindset of an investor, specifically a value investor. We talk about his process of looking at companies, where he came from and where he's going. This acts as a great learning tool for you at home to see how a great investor thinks. So here goes. This show started Paul and me arguing with him how value investing was wrong. I was invested in Tesla and Bitcoin. Those is what everyone does, and that's the best way to go. Was there an aha moment for you that said, this makes sense? Because it's happening for me in real time for our viewers, as Paul you talk about this, how you don't think this could be learned.
No, I don't say that. I do think it can be learned. Warren Buffett kind of has said before, hey, you either get it or you don't. And obviously, Warren Buffett is incredible. I don't necessarily agree with that. I feel like it's the first time I remember hearing about value investing, I remember thinking to myself, yep, that makes sense. Mm-hmm. Seth had been a longer process, 3 years now, but I see him now going, yeah, Paul, how do these people justify this? And I'm like, I joke with them and I say, look at our little adorable Seth learning along the way. Yeah. But he's been around us and we've been talking about it. So it's been more learned on Seth's part because he's around me all the time. And I talk about, I just put on the wall, Seth, here's 5 years of cash flow. What do you want to pay me for this cash flow? Mm-hmm. This breaking it down like that, he goes, oh, that makes sense. That makes sense. Yeah. Like that's what we do with a company. Every investment's the present value of all future cash flow. Yeah. So I guess his question to you is, was yours the aha moment? Or was yours more like his, where it was like, wait, okay, I get that.
That makes sense. Yeah.
I don't get that. Like, how was yours?
Well, so I think when I read about Buffett, what I realized is that basically the stock market is an auction-driven market.
Of course.
Yes, it is.
And an auction-driven market will always overshoot or undershoot. It's just the nature of the beast, because people are, either the animal spirits take over and it goes crazy, or people just hate something.
Yep.
And so very rarely are businesses actually appropriately priced. They usually are all over the place. And one reason to, I would say, framework which tells you that is, if you own a home, okay, and I go to my friendly realtor and say, hey, John, what's my home worth? He say, oh, your home's worth $200,000. I say, oh, thank you, John. I call him next day. I said, John, what's my home worth? He said, 200,000. Mm-hmm. I call him third day. He said, listen, dummy, it's still 200,000. Okay. I call him after a month. He'll say, I think it might be 201,000. Okay. It might have moved by $500 or $1,000. If I sampled him for the whole year, every single day, okay, that home value would be between 200,000 and 205,000
right,
for the whole year. Okay. If I look at IBM stock over a 12-month period, okay, its value would be 100 to 200.
Yep.
Okay. And if you throw a dart at any company on the New York Stock Exchange and just look at the 52-week range on it, and the reason it's like between 100 and 200, it's not that when it was 100, IBM was doing terribly, and it's 200, IBM is doing great. It's the sentiment of the auction-driven market.
Yep.
And so that is why value investing works, is the range of prices that you start seeing. And, Buffett used to use the Moody's manual. He used to go through all these companies. And in fact, when he was teaching the MBA students who would come to Omaha, he would say, look, I found this company, Western Insurance, it had a market cap of $15 million. And last year they made $25 million. Okay. And they have $30 million cash, no debt. Are you going to buy that business? Sure.
Yeah.
The numbers make no sense, right? And so in auction-driven markets, you will periodically get weirdness in your favor. And so the idea is that, I don't know if you guys remember that Seinfeld episode when Elaine broke up with her boyfriend. Well, they're on a flight together.
David Putty,
right? David Putty and Elaine are on the flight
they're
together.
Coming back from Europe.
Right. And Putty is just looking at the seat in front of him, right? And she asks him, what are you thinking? He says, nothing. He says, "You're looking at the seat in front. What are you doing? Nothing.
I can't take this anymore.
And then, so she broke up with him. On the flight, she broke up because she couldn't handle the fact that Putty's doing nothing, right? But if you can be like Putty as an investor, you find invested in insurance and go back to just looking at the seat in front of you. If you get excited about watching paint dry or watching the back of an airplane seat for long periods of time, this is the business for you.
Go ahead.
Did you always have that? That was just in you.
Well, I think the way I look at it is that I'm like like I told you, I like to play games.
Mm-hmm.
So and I went through some psychological testing on this. So what they told me, and which I kind of knew implicitly, is that I'm a specific kind of game player. So number one, I prefer individual sport to team sport, where I can control outcome, right? I wouldn't be a guy who would be really excited about a soccer game,
right?
Okay, because you got a team and you got to coordinate all this stuff. I'd be more interested in like tennis, for example, or ping pong.
William Green talks about this in the book. Like a lot of these value investors are drawn to chess, tennis, being on their own.
You can control the outcome, and so the idea is that if there is a single player game, and if the rules can be well understood, and if I feel that in this game I have an edge. So what my psychologist told me is, Mohnish, here's the thing. You like to play single player games, but you don't just like to play any single player games. You like to play single player games where you have an edge, where you know you can win. So you kind of like it when you can win. And so you kind of look at the game rules and say, I think I can take this one, right?
Like what?
Like I like to play bridge, right? Bridge is mathematics, probabilities, all that. I've been really good at math all my life, right? I've always been good at math in school. I love playing bridge, okay? And in investing, basically, what happens is that you just need two skills that are hard for many people. The biggest skill that's really hard for many people is patience.
Extreme patience.
Extreme patience. You need to like Putty. If you can just watch the back of that airplane seat and be so happy, that's it, right? Most people can't do that. They need activity. They need stuff going on.
Yeah.
And the second is that if you figure out the rules, so the rules are very simple. A business is worth the sum of future cash, present value, right? But the thing is, that's kind of complicated for IBM and Microsoft and Google and all these companies. It's not so easy because they're not so cheap, right? But sometimes you run into businesses where it's super obvious, like this Western insurance like Buffett bought, okay, where you say, okay, now I know this is stupidly priced and I know I can be patient. I'm just going to buy it, put it in the drawer and go back to looking for more stuff.
Yeah. Well, but you said right there, it's complicated because they're expensive. To me, that's not complicated. It's just, okay, I like their business. It's why we have 8 pillars and it shows check marks and X's. We love the ones that have 6 check marks and our 2 valuation metrics are X's. And I always say, keep an eye on this one and wait till these X's become check marks. And then you start the product. To me, this is my opinion. It's not complicated when it's overpriced. It's just not for me.
Well, it's not necessarily overpriced. It may not. I mean, a business that 100 times earnings is not necessarily.
If you're going to grow 50% a year,
like PeopleSoft grew into it, right? So we cannot say businesses that are where the multiple is high are automatically bad investments. That's not true. Sometimes a really cheap business is a bad investment because they're in decline. Yeah. So, but when you were talking about the aha moment, so the aha moments come when it hits you over the head with a 2x4. Like I've mentioned before, like I was in Turkey in 2019, and I'm visiting all these Turkish companies, and one of the companies I visited it's the number one warehouse operator in Turkey. They've got about 13 million square feet of warehouse, 99% leased. The tenants are like IKEA, Amazon, Carrefour, very blue chip client base, 10-year leases. And the market cap was 20 million. And you could, on a bad day, sell the entire portfolio for $1 billion. Okay? There was $200 million of debt. Okay. So,
You have $800 million.
I mean,
exactly.
basically, it's like, you're paying 20 million for 800 million of value. You're paying like 4 or 5 cents on the dollar. So, or 3 cents on the dollar in that case. I said, and so, like my Turkish friend who took me there, great value investor. I said, are they crooks? Like,
Yeah, well, I mean,
Yeah,
I think
how-
to myself, what's going
I
on?
said,
What's this?
I said, he said, I've never heard anything untoward. They're high quality people. I said, I don't see this anywhere in the world.
Right.
Okay, I don't see this like something worth hundreds of millions is trading for 20 million, right? And I met the father and son who run it, and I can judge people pretty well. And I said, I don't think these guys are crooks. I think these guys are hardworking, smart guys, and they didn't understand the stock market very well. They didn't fully comprehend the amount of wealth they had from a market perspective. They had some. I mean, they just weren't savvy on markets and but they didn't care. They controlled the company. They didn't really care what the market was saying it's worth or whatever. That was irrelevant to them. And I spent an afternoon visiting the warehouses, with the son. We drove around and I told him to take me to the warehouses. I want to just see them, kick the tires, right? Extremely high quality places, very pristine and great areas. And because, Amazon and IKEA and these companies, they will not take, Mickey Mouse stuff.
Right.
And then there are a bunch of other businesses. They had the largest truck fleet in Turkey. They were the second or third largest freight train operator. Now they're number one. And just, bunch of other businesses that they were doing. And I realized the way they enter businesses, that their model for capital allocation was really strong. They're basically not interested in anything where in a year or two, they don't get the money back. If they put money out and they don't get it back in a couple of years, they're not interested. So 40-50% ROEs is kind of where they're at. And so I said, okay, we're going all in. And I own a third of the business now. I was shocked that I was able to buy it. Turkey is a crazy gambler's market. It went from 20 million to 140 million market cap in about 18 months. And it's still cheap. It's still not gotten to where the value is. But, we're watching paint dry.
What's the free cash flow in that business?
The free cash flow is pretty good. I mean, it has some noise in it because the interest rates keep moving around, and Turkey has a lot of noise with the exchange rate. But basically, I think their business on a steady state is in the 30-40 million free cash flow.
So when you saw
their earnings exceeded the market cap.
So when you so that's the question. So how did it get to 20? Were you intrigued by this because your friend called you and said, this stock keeps falling, you got to come here and check this out because now it's selling for an unbelievably low? What was your...
Actually, the funny thing is, he wasn't an investor, right? So I asked him, I said, why aren't you an investor? And I explained all the economics to him. And after we went through all the, seeing all the warehouses and all that, he bought the stock. So he wasn't an investor, then he became an investor, and it doubled and he sold it. Okay? So I said to him, wait a minute. What's going on here?
Yeah.
He said, Mohnish, you don't know Turkey. This is like a very volatile market. I'm getting double. I said, this is value gap.
Yeah, right.
So can I ask you a question? Why didn't you just... I imagine, was it possible to privatize them? Just buy, go to them and say, what were the father and son doing that didn't allow you to even privatize the business and just say, I'm going to get my money back?
First of all, I'm not an activist investor.
Okay.
And secondly, I don't have control of the investment. And I would not want to do something to that business which they are not in favor of.
Well, okay. You mean in terms of taking all the shares?
So
okay.
I think the father and son are savvy, and I think they, most entrepreneurs, if you look at a company like Walmart, okay, the Walton family, they're not going to sell Walmart if someone offers 30% more or 50% more.
Yeah.
Okay, that's not the game they're in, right? So many times in Walmart's history, someone could have come and offered a 200% premium, and it would have been a great deal for the buyer. Okay, the family wouldn't have sold.
Right.
Because I think for them, there are other factors beyond just, because like Buffett says, if you're an owner of a business, you already have the wealth. Now, whether you monetize it and it's in dollars in your account, or whether it's in the warehouses that you own, it's apples to orange. So I think that it is not always a logical. So even if...
No, I didn't mean it like that. I meant it for, was that an opportunity for you? I'm sure the family has 1,000 reasons why they didn't, but I meant for you.
My take was that the bedrock of value investing is that eventually the market is a weighing machine.
Yes.
So what Ben Graham said is, voting machine in the near term, weighing machine in the long term, and watch paint dry in the meanwhile. And I don't have a doubt that 5 years or 10 years from now, the racehorse in Turkey will get appropriately priced. It'll get appropriately priced. It just cannot not be appropriately priced. And if you think about it, it sat at a 20 million market cap for more than 10 years.
Wow.
Okay.
Oh, wow.
Wow.
Okay. Now, it wasn't worth that much 10 years ago.
But now it has.
So what happened is that probably 10 years ago, the value was 40 million or 30 million, and it was sitting at 20 million. And the value grew. And these guys, the father and son, they do a very poor job of explaining the business to the street. There is no deck. Okay. There is no...
Good for them.
There's no IR department. Okay. And I actually asked them, I said, listen, why don't you put out at least a simple investor deck? They said, why? They said, we are fine with the business. It's okay.
Good for them.
And actually they were a little surprised because they wanted to buy more of it, and they thought it never goes up in price. So they have freedom to buy it whenever. And then suddenly it went up, and they were saying, oh, I wish I'd bought some more.
So, we talk about, it's funny you say 10 years. And, one of my examples all the time about stocks is the perception when we talk about Microsoft. So Microsoft was one of my first real true value plays in 2011 and 12. Because I remember hearing everybody telling me this company is dead. When 10 years before it was, this company's untouchable, nothing's going to hit it. So in that 10 years, the stock fell 80%, I think 78%. And the business got 5 times better.
Yeah.
Right. And it's these times that you sit there and go, when we look at Mexico, so we have some homes in Mexico where we rent out. And I went on vacation in Mexico. And I remember my lawyers in Ohio saying, you better not buy these houses. I'm like, why not? You're going to get kidnapped. You're going to get murdered. Things are going to happen. It's like, and then my dad calls me, Paul, do you realize you can't own? Did you realize the cartel looks for people who buy houses in Mexico and they kidnap them? I'm like, oh, I didn't know that. He goes, yes, they do this. I'm like, okay, well, nice knowing you, Pops. But there was that mispriced judgment, like Turkey you have. This is mispricings. And I look at these things and I'm surprised to hear you say it took how long do you wait for these invest? Like for our house in Mexico, they generate cash flow every month. Somebody send me right now, Paul, what are they worth? I don't know. I know what the business is. I know what the business generates me per year. I invested $2.2 million. It generates $500,000 in profit on 2 houses. Sounds pretty good to me.
That's very good.
Right? But with no debt. But how long are you going to wait for? If you'd owned that stock, let's say 5 years before, even 10 years before, you thought it was worth 40, you bought it for 20, and you sat there and waited and waited. At year 5, are you going, what's going on here? Like, how are you approaching that?
So I think what I have found is with this particular company, I'm not even concerned so much about the value delta. What I find is, which is I find really amazing, is that the son is better than the father, and the son is 36 years old.
Oh wow!
So you're looking for
the father is about 62 or something. The father's really good too. I mean, I think that the two of them have a great yin-yang. The father's very aggressive. The son has a bit of an accountant streak in him, so he kind of holds him back a little bit. And so the two of them actually work really well. And the other thing is that they have they don't realize this about themselves. They're exceptional capital allocators because I think the way they think about it is like I'll give you an example. When we invested, they were not in the solar business. Okay, or if they were there, were very small. Some German guy came to them. Okay, this just to show you how they work, right? Some German guy came to them and said, "I'd like to lease the roofs of all your warehouses. When you lease your warehouse to IKEA, you never agree to lease the roof to them, so the roof is still available."
Yeah.
So the guy says, "What do you want to do with the roof?" He says, "Oh, I'm going to put solar panels on it." He says, so they said, how does that business work? So the German guy explained to him that Turkey had passed these net metering laws, the same as what we have in California, where basically the utility has to pay you for electricity you generate the same rate that they charge you. Okay, that's the net metering law. And so basically, if the electric rates go up, then what they pay you goes up as well. And what happens is in with solar panels, the electricity is generated at prime time, right? It's prime time is when it's daytime. So you're getting paid the prime time rate. And I had solar panels in my home in California. We stagger all our usage, right? So the dishwasher runs at night and the washer runs at night and the cars are getting charged at night. The rates are all low at that time, but I'm pumping to the grid when I'm at work at a high rate. And so actually for several years in California, I paid zero in utility bills. We run the AC, we run everything, it's zero because of that thing. So when they ran the numbers, they told the German guy, "We don't need to lease it to you." So they didn't know anything about solar business. They took one of their warehouses, they found a contractor, put the solar on, saw the numbers, realized that Turkey has no fossil fuel, so they're importing everything every year, and those rates keep going up. But once you do the solar, your capex is done. There's no cost after that, but your revenue keeps going up. On a pure equity basis, they get all their money back in 4 years on those solar panels. It's incredible. And the panels...
So it's a failure for them because they want it back in 2 years.
Yeah. He went for
this
4
sucks.
Exactly. First, he was not very interested. But then he said, let's go ahead and do it anyway because we can finance it. Once you put some financing, he's getting it back in 2 years.
Oh, yeah. He's getting his equity, yeah.
Yeah. And the thing is that the panels that were built 40 years ago are still running today.
Wow.
The ones that were built 40 years ago had a 30, 40-year life, but they're still running today. The ones that built today, they may go 60, 80, 100 years. We don't know yet, but they're a lot better. And so what I feel about this company is it's not so much the valuation gap. I just like the allocators. So out of the blue, the solar business came up. The solar business is probably worth 100, 200 million already and probably worth more in the future. So why not?
What do they do with their free cash? Are they paying out any dividends or anything? I mean, I know it's...
The dividends are minuscule. I think what they're looking at is their debt reduction, and they have a lot of growth on their rail business. So they own 3 rail stations. In Turkey, you cannot own the rail network. Rail network is owned by the government. But they own the rail cars, and they're not allowed to own the rail engine. So the train is run by the Turkish government, but they own the rail cars. So they have these deals with Toyota and whatnot. The trains are running. So they are pumping money into those businesses. So what I've realized with these guys is just they're smart allocators. They've got skin in the game. They're pretty straight. Let it rip. I've got the warehouses. Now I got the solar business. And I'm going to Turkey in January, and we'll see what else I'm sure they might have created something new that I don't even know about.
We're busy. We can't make it on that trip.
I don't think so.
Too bad, man.
Can I ask you a very blunt question?
Yeah.
We'll pivot here. Buffett and Munger, who do you like more?
That's
I'm just kidding. I'm just kidding.
I would say no. If I answer the question, I would say it would be Munger.
I knew you were going to say Munger,
but the reason. So Buffett is very narrow. He loves the compounding game. Munger has an interest in many games, right? He's not just making money. He's like he's interested in a number of things. And the other thing is that Buffett, because of his, all his stature and being well known, there's a layer of diplomacy. When you talk to him, you're going to get answers where he just assumes whatever he tells you gets reported in the New York Times.
Yes.
Okay. And Munger doesn't care if it gets reported in the New York Times. He will still tell you what it is. But I would say either one is great as a hero, and happy to know them both.
So it's funny when I was watching one of your interviews on YouTube, and the prompter asked you that question when you had your lunch with them. He said, I actually enjoyed Charlie more than Buffett. Then I enjoyed Charlie's secretary more than Charlie.
Yeah, Buffett's secretary.
Buffett's secretary more than, it was great.
Yeah.
That was great.
The lunches with Debbie Bozanic, Buffett's assistant,
that was great.
Were way better than the lunches with Buffett. They're way better. I mean, because I would tell Debbie, I'd meet her on Thursday before that meeting. I'll say, Debbie, between us girls, can we talk? She said, Mohnish, we can talk. What do you want to know? So then, this was like in 2009, 2010. I say, does he have a cell phone? Okay, now we know he does, right? She starts laughing. She says, he does have a cell phone. It's lying in the drawer of my desk. And she said, he doesn't know how to use it. And she said, it's a flip phone. And she says, all he knows is that when it rings, just unflip it. That's it, okay? So she says that I make sure it's charged and I give it to him. And when it rings, he knows I'm calling, and because I'm the only one who has a number, and I patch through whoever needs to talk to him. And that's how it works. And Buffett was joking that during the financial crisis, there were Lehman or Barclays or something was going on, and someone was connected through and they left a voicemail for him about some deal. He got it like 3 years later.
Wow.
There's nobody
So
check that.
some deal, something going on.
Sounds like my
Yeah. So anyway, I mean, I asked Debbie a lot of questions about how he deals with his mail and his daily routines and different. It was just great to really understand how he works and such. It was great.
The reason we created the software was exactly for this, because people watch the videos, want to do their own analysis when they see me do this. So we created the software so people could do this. You get everything you see here on the Everything Money channel, on the Everything Money page, all our tools, plus all the ones coming up. You get over 30 years of financial data. You get access to Seth Mo and I. You get all the 8-pillar analysis, that stock analyzer tool, real estate calculator, retirement calculator, 8-pillar portfolio. We can put in 50 stocks at once. It tells you how they all look as a portfolio. All of this plus exclusive daily content. We have 1, 2, 3 videos a day that we release only to our users of our software. You get it all in mobile form. All of this is available on your mobile app, all for only 90 cents per day. 90 cents per day. If you can increase your returns or decrease your losses by 1 or 2% a year, that could lead to hundreds of thousands, probably even millions of dollars in extra net worth for only 90 cents a day. 2 ways to sign up, everythingmoney.com or Patreon. The benefit of everythingmoney.com directly is you don't pay sales tax yet because we're not big enough. So sign up, only 90 cents a day. This is a no-brainer, less than a cup of coffee.